We now come to the final session of the day, and I'm sure most of you would have been looking forward to hear the views from the who's who from the wealth management industry. Our next session is titled Disruption in Wealth Management, a Holistic Perspective. To start off, I would like to introduce you to the first panelist, Miss Sucharita Mukherjee. She is very passionate about access to financial services for all. She is a co-founder of Kaleidofin, a fintech platform that provides intuitive and tailored financial solutions to underbanked customers. Sucharita was chosen as one of the top 40 under 40 business leaders by Economic Times in 2016 and named amongst India's top 20 fintech chain makers in 2017. Prior to her move to India, Sucharita was an investment banker at Morgan Stanley and Deutsche Bank in London, working primarily on the credit derivative structuring and sales. She's graduated with an MBA from IIM Ahmedabad and an undergraduate degree in economics from LSR Delhi University. Sucharita, I would request you to come on stage, please. Our second panelist for the day is Mr. Subramanya SV. He is a co-founder and CEO of Fisdom, a platform for personal finance across investment, savings, and protection. Fisdom blends technology with financial advice to bring simplicity, accessibility, and trust in the financial investments for the vast underserved population in India. Prior to Fisdom, Subbu was a partner at Bessemer Venture Partners, where he led the firm's technology investment activities in India. He served on the boards of Bharat Matrimony, Taxi for Sure, Snapdeal, Nephroplus, and many others. Subbu also holds an MBA from IIM Ahmedabad and a bachelor's degree in engineering from Mysore University. Subbu, welcome you on stage, please. Our third and final panelist for the day, Mr. Varun Malhotra. He is a principal at Quona Capital and has a decade of venture capital investing experience across technology, financial services, startups. Quona Capital is a venture capital firm which focuses on financial technology for the underserved and invest across emerging markets. Varun focuses on Quona's investment activities and portfolio in Asia and was recently recognized by Forbes 30 Under 30 for venture capital in Asia. Welcome, Varun. I would now like to invite the moderator for the session, Mr. Uday Dhoot. Mr. Uday Dhoot has almost 16 years of experience in the field of wealth management and investment advisory and is currently the founding partner at Venn, which is a firm focused on building a multi-family office setup for new age entrepreneurs. He also plays an active role in the local CFA Society and as a part of advocacy team. He is a Bangalore University rank holder during his BBM days, a CFA charter holder, and a CFP certificate. He can regularly be seen in the news channels such as CNBC Awaaz, CNBC TV 18, ET Now, and you can find his quotes and articles in various newspapers and magazines. Uday is a marathon runner and a daily yoga practitioner. Uday, I would welcome you on stage. Thank you.
Hi and good afternoon, everyone. Welcome for the last panel discussion, last event for the day. I hope you had an enjoyable session so far. Yes? Thank you. So very quickly, we have around 1 hour, 15 minutes for this whole discussion. How it will go in is that Sucharita will make a presentation about Kaleidofin and what they are doing in this space, followed by Subbu talking about Fisdom. And then we'll get into the panel discussion, have a bunch of questions amongst ourselves, and then open it up for the audience for the questions. So look forward to your participation. I request Sucharita to come and make her presentation.
Thank you so much for that kind introduction, and it's really an honor and a privilege to be with such a talented audience. Where did the idea of Kaleidofin come from? Kaleidofin, the name itself comes from beautiful possibilities of a future life for every customer. The idea of Kaleidofin came from two places. One was that there is just a vast number of customers in India, 800 million, 900 million customers in India, who do not have access to even basic financial services. And in some sense, while a lot has happened on the credit side, very little has happened on the financial planning, investment, and wealth management protection side. So we saw a huge opportunity for impact. We saw a huge business that could be built out of these customers. That was one. The second realization, and which was a more, I think it applies much more to every customer, is that today finance in India and probably every part of the world is very manufacturer-centric. So, mutual funds sell you fund products, banks sell you savings accounts, insurance companies sell you insurance, and it's all very bewildering for the customer, right? Because it's still one customer, it's one life. Every customer has goals, but you have 5 people coming to you and talking to you about their products. Imagine if you wanted to buy a car and people instead directed you to the tire shop and the steering wheel shop, and you had to somehow choose all of these different parts and assemble the car yourself. How bewildering would that be? So in some sense, finance is not at all intuitive, and the big change we want to make is from products to solutions. The word product itself is very manufacturer-centric. What customers really need are much more intuitive solutions that really make their life's goals happen. Where is this approach needed the most? It's undoubtedly the 800, 900 million customers in India who don't have basic access, who are living on small surpluses, but yet they dream of the same things as you and me. They dream of a better life for their children, that their children are better educated, they want better homes, better working conditions. So the dreams are not very different. So that's how Kaleidofin came together and to really propel customers towards their dreams, their life's goals by providing them very personalized and intuitive financial solutions. There are very large gaps, in financial services access today. And this 800, 900 million customer base is actually very, very diverse. The way product development has worked so far is that one size fits all. The most common example of a micro insurance contract used to be that, a person like you and me, we buy 2 crores insurance. Let's take the example of our housemate. She should buy 25,000 rupee insurance. And that makes no sense, right? The people in this room realize that that makes no sense to anyone, right? 25,000 rupees does not cover the basic human capital of likely anyone. So, the product development has been quite condescending, has not been thoughtful, not really been thinking about the needs of this customer. What does this customer do today to meet their life's goals? There are 2-3 things. They invest in chit funds. They invest in gold accumulation plans, and the only long-term formal financial product that has really made a dent in this market is LIC. And if you look at any of these instruments that these customers have access to, there are big problems in each of them. Chit funds are not regulated by any of the central financial regulators, and the money is subject to fraud. And in some sense, we see when we visit the field that almost 25% of the customers we have met ever since we started Kaleidofin have lost money over the last year in chit funds. That's a very high number. Feels like a crime, felt like, okay, something urgent needs to be done to change this. Take LIC. LIC has the reason why they've been able to penetrate, and there are a lot of learnings from an institution like LIC, is that they have a fantastic agent force, right? And the agent force means, the agent force comes from the community. They are people who look and feel similar to these customers, treat them with respect. So those are all the good things about the LIC network. But the product itself, again, has a lot of inflexibility built in. So our customers have been sold LIC policies where if you miss a payment, you actually lose principal. Can you imagine that? You miss a payment and you lose principal. One of the unifying factors about this customer segment is that if you work in the informal sector, and more of even the urban economy is turning informal with the gig economy, because people are paying as you go, right? The volatility of income is very, very high. We actually did some primary research which suggested that the volatility of income is as high as 45 to 50% on the income side, as high as 45 to 50% on the expense side. Imagine how hard it is to make a payment on a certain, quarterly date for sure by a certain time. Right? It's not easy at all. And then on top of that, if the penalty is that you actually lose principal, that product is not good for you. Not good for somebody who has such a high volatility of income. So clearly the current financial services markets has failed this customer. That's why Kaleidofin. And in some sense, there are 600 million of these customers, so there are big, it's a big problem to solve. What does our business model look like? So clearly when we think about 800 million customers, we have to find, first of all, a way to reach them, right? And let me give you a picture of these customers. Our customers are typically, let's say, housemaids, vegetable vendors, potato chips sellers, tiffin makers. These are our typical customers. That's what they look like. Their incomes range between, something like 7 to 10,000 a month to maybe 25, 30,000 a month. Most of our customers would fall within that segment. And most of our customers are also feature phone users. So now when we put all of this together, how do we reach these customers? Because that's a problem to be solved. So we thought about it, and we thought that it would be great to actually leverage existing customer networks that are present in the country, and actually get those customer networks, such as microfinance institutions, such as NGOs, such as dairy cooperatives, such as regional rural banks, cooperative banks. We could get to large numbers of these customers through these networks. So we thought that a network acquisition strategy was actually a good one because, for instance, let me give you an example. The microfinance institutions themselves cover 35 million customers. Banking correspondent agents would cover about 60 to 70 million customers who are actually doing active transactions. Now, the sum of all this still doesn't total up to 800, but we thought, well, okay, we've totaled up to 100, that's a good start. And therefore, the network partnership strategy. So Kaleidofin actually partners with MFIs, trains their field staff who are essentially feet on street, who then go out and talk to customers about their goals. We have developed an assisted app. The assisted app actually is very powerful. What does the assisted app do? It's an assisted app is because basically it's someone helping the customer to enroll, to do the financial wellness tests and so on. The customer app actually connects to a range of product manufacturers at the back end. So we developed a technology platform that actually really ties up with banks, asset management companies, insurance companies and so on, and is fully integrated at the back end and is able to execute each of these contracts. So when a microfinance institution field officer goes and has a conversation with the customer about her goals, and she says that, look, what I want to do is send my daughter to college 5 years from now. I know I will need about 3 lakhs. Our engine actually provides a real-time financial health assessment as well as a real-time personalized financial plan that you can execute there and then. Has this taken off? I would say yes, in a big way, because of 2-3 simple things. One is that customers recognize that the value of safety. First and foremost, customers want their money to be safe. Only second, to maximize the yield. Second, they also realize that the solution has been tailored to their requirements. So the second question they generally ask is, what if I don't have the money on the 5th, which is the date you gave to me? We say, no problem, no penalties at all. And that's very important to them. It's because even in a chit fund, I don't know if there are any guesses for the penalty per day of not paying your chit fund contribution on time. It's much more than anything any of us pay. It's 500 rupees per day. If you pay late, it's worse than a loan. So those are the few questions that people ask. And then, I don't think anybody is really asking the question around, is this fund really suitable for me? That's really our responsibility. But at the end of the day, the customer is now able to get a very, very personalized financial plan that is executable there and then on the field at the customer's doorstep. We think that this is potentially life-changing for many customers. It's a fantastic business because the platform can create a lot of scale. There are many, many such customers. And today, overall, we are in about 7 states of the country. About 30 such networks have signed up. What we really want to create, if we just step back for a second, what we really want to create is a world in which customers' interests are protected. Today, all of us have seen miss sale, but this customer has really seen a lot more than any of us. And we do want to make sure that through our work, we create a world in which customer protection is really non-negotiable. In every sale, advice is inherent. It's already there whether you like it or not. And therefore, the provider must take responsibility for that advice. So we really want to create a world in which customers' interests are protected and then maximized. And we feel that Kaleidofin's platform, in which many institutions can easily plug in to our platform, which provides the technology backbone, which provides the analytics engine, the learning engine that provides the personalized recommendation, has the integration with all the product manufacturers. We think that Kaleidofin could be, although we are very young right now, each of these numbers are small, we think it could be potentially transformational. And, and some of the, learnings we've had along the way have been much more around how do we integrate ourselves operationally with our networks. How do we make sure the agent is as much our customer as the customer is our customer? How do we make sure in the development of technology that we actually make the agent's life easier? And how do we continue to develop newer financial solutions that really meet the goals of people? I will really end there, but we'll be happy to take questions at the end of the session. Thank you.
thanks Sucharita for that brief presentation about what Kaleidofin is doing and what it wants to do. Can I request Subbu to come and talk about Fisdom, please?
Hi everyone, am I audible? Cool. Thank you so much, Kailash, everyone for having me here. Huge respect for all of you. I was just telling during the break, getting to IMS, people say getting to IMS is tough, but I think doing 3 levels of CFA is a lot tougher. It's a 3 years marathon, so thank you so much. Let me start with a quick background by the time the deck comes up. We started Fisdom 3 years ago. It's been a 3-year journey for us now. We essentially started Fisdom with the mission of saying, look, financial products are hard to access. There is too much jargon, there is too much fluff around here. Let's do something that makes it simpler and more accessible for mass and mass affluent. That was a simple statement that we started out with. We didn't say specifically we're going to do product A, product B, product C. There's a large number of customers who want to access financial products, but they're finding it tough for a variety of reasons. We'll talk about some of those things. It's been 3 years. We now have 2 products, Fisdom and My Way Wealth. I'll talk about each of this in a minute. How does this work? Sorry. Okay. Anand is my co-founder. I just thought I'll tell you about, we've been blessed with some really high quality shareholders, including Quona Capital. Thanks, Varun, for funding us. Let's take a step back and say, what is the problem we're trying to solve, right? India has always been a high savings economy. Our savings to GDP ratio is 30 to 40% in that range. All of us have saved money, our parents, our grandparents. The only problem was the money has always been here, gold and real estate. Imagine 70% of our savings all through the generations is stuck in gold and real estate, and everything else is kind of negligible. A large percentage of our savings, excuse me, is in 3 primary assets, right? One is bank deposits. We all love FDs, we all love recurring deposits. Then gold and real estate. Imagine for a $2.5 trillion economy, our bank deposits are $1.5 trillion. It's a massive 60%, 65% ratio. You look at any economy like US, it's 5%. China may be closer to us because of their own sort of issues. But any developed economy, bank deposits to kind of GDP is in the 5 to 30% range. But for us, it is as high as 60, 65%. So if you look at any specific financial product, right, whether it is mutual fund, insurance, you will find severe underpenetration. So I would think after bank deposit, the easiest and the simplest financial product that anyone can access is a mutual fund. It's so easy, like it's regulated, there are experts who are managing it, fairly simplified. But guess what? Our mutual fund penetration, this is mutual fund AUM as a percentage of GDP. 10 to 12% range, right? So on a $2.5 trillion economy, we have about $300 billion of assets under management. Of that, guess what? 150 came in the last 4 years. Most of it through value appreciation. It's only the last 4 years, if you see, people have actually started moving money from elsewhere to equity. And there is a reason why it's happening, because of the structural changes. One set of structural changes is one could get a FD at 10% 5 years ago. Guess what? Today it's 6%. Gold has been at this 2,000 to 3,000 rupee per gram now for, I don't know, probably for 10 years. People used to make money in gold, but no more. Real estate, look, I mean, I always keep saying, for you to make money in real estate, you have to be first rich. Rich can become richer through real estate. If a normal salary earning customer cannot become rich through real estate, there are other means. Plus, there are other demographic factors. For example, millennial population, internet. Like earlier in the session, Varun talked about Flipkart, Amazon, Paytm. Thanks to their cashbacks, today we have 30 crore people who have transacted online. Right? Online transaction today is a reality, whether we like it or not. Somebody might say, it's been funded by cashbacks. I would say, who cares? Like today we have 30 crore people who are comfortable using a debit card or a net banking or a UPI or a credit card to buy something. And that's a huge change compared to 10 years ago. I'll give you a couple of examples why financial services is the next sort of frontier. Go back 10 years ago, before Ola and Uber, If you had to go to an airport, you would call your neighborhood taxi wala and book a cab. And if the guy doesn't turn up, you'd be like, you'd call him, "Arey bhaiya, kahan pe ho? Where are you? What can you see? Can you come?" Today, 2019, you book an Ola or Uber. If the driver calls you and asks you, "Sir, where is the address?" You will say, "Boss, location de kya ho?" Right? So, I mean, look at our behavioral change. Earlier, we would be so people dependent. Today, don't even talk to me. Similarly, e-commerce. Today, you go to a mall. If some sales executive comes to you and say, "Can I help you?" Your reaction is, "I'll do it myself, don't worry," right? I think there is a huge behavioral change that we are going through as a combination of all this. The last point is, we are lucky. I think there is significant regulatory tailwinds. Aadhaar has taken a little bit of a, what should I say, some step back, but I think it'll be fine. If you look at a consumer's point of view, I think I want to spend a couple of minutes and then we'll end. I think there are three fundamental issues for the customer, and this is true for everybody, whether you're somebody who's trying to invest 5,000 rupees or 5 crore rupees. And the first one is paradox of choice. I think there are a lot of wealth managers here, including Uday. I think one of the ways wealth managers have sold their products in India is by throwing jargons and confusing the customer. Throw jargon so much that the customer will say, "Boss, where do I sign? Please leave me. I just want to sign and run away," right? I think, and look at there are 1,800 products, every mutual fund. Just take mutual fund, growth, equity, dividend reinvestment, whatnot, and then debt fund and equity. There's just no shortage to the number of jargons we have thrown. Insurance, for example, this extra, that extra. This the whole product ecosystem is geared towards confuse the hell out of the customer so that you take some money out of him. I think that's a true problem as we grow from, let's say today we have 1.5 crore people who ever bought a financial product, right, excluding LIC. Now, if this 1.5 crore has to go to 10 crore, this problem has to be solved. Second was KYC. It's been extremely painful. Signed tens of papers, put attachment documents. Finally, advice, at the end of the day, as Sucharita mentioned in her presentation, the moment you move out of a bank deposit, there is an advice involved. Whom do you trust? And at the end of the day, there is a significant principal agency relationships. Banks have missold, brokers have missold, everybody has missold because of the fundamental market issues. SEBI removed upfront commission 4 months ago. Guess what? Mutual fund inflows are down to their 10-year lows, down by 50% in the last 4 months. The upfront incentive is gone. So I think, so this is the consumer problem. So we said we will build Fisdom as a platform that solves these problems from the customer's point of view. So we look at it as a sort of a guided choice platform where we don't complicate the customer's life by giving him too many information or too many choices. Keep the choice limited, but then give the specific recommendation, but hide the complexity. For example, risk profiling, asset allocation, tax optimization, all those things today, the software can take up a lot of that, which a human being would have to do. And those can be made selectively available. So we call Fisdom and My Way Wealth both as sort of a guided choice platforms with hidden complexity where you want complexity, it's there, but if you don't want complexity, you don't need to. So we're trying to serve a large underserved market, and we kind of categorize our solutions into wealth generation. Some line. So wealth generation, protection, savings, and other products. So right now we're live with mutual funds, life insurance, pension funds, and gold. This is digital gold, not physical gold, and we hope to add more products. So last slide, we have multiple channels by which we reach our customers. Fisdom is a consumer app which you can download from Google Play and App Store. But the predominant channel that we distribute this product is through in partnership with banks. So there is a long list of mid and long tail banks in India who have access to customers who are deep-rooted in distribution, but they're not doing anything. So we work with those banks and help their customers access product. Then we acquire customers directly. That's through a separate brand, My Way Wealth. The product is sort of similar, but only difference is we acquire customers directly, and through My Way Wealth we offer direct plans of mutual funds. And we also work with Bank of Baroda on a sort of a B2B partnership. So our customers love our products. Sorry. Yeah. Thank you.
Thank you, Subbu, for sharing about Fisdom and what you guys have done so far. I think both your presentations were insightful, very different segments Before I get into some questions with you guys, I have some questions for Varun because he's the one who's putting in the money behind all of this. As a VC, when you look at this space, how do you see the automation and the inclusion piece? So how do you sort of put them together? What are your thoughts?
Sure. No, at the outset, I just want to thank you for the great presentations. I think we can all go home. We've covered most of the issues that do exist and the solutions that are coming up in the market. But talking about automation, inclusion, access, all the things that we've been discussing over the last two presentations as well. I think each market, and just to sort of set context, at Quona we cover emerging markets, so it gives us an interesting vantage point to see how different markets, be it some of the developed markets that we use as reference points, or like the US, or even like China, which is rapidly grown erstwhile emerging market, or markets across Africa, Latin America, gives us an interesting vantage point to compare, contrast on how different markets have developed and what can we expect in newer markets that we're exploring. And at the outset itself, I mean, they're fundamentally different, right? I mean, the contours of each of these markets, the consumer behavior patterns, the market gaps, the rails that you operate on are fundamentally different across, right? So each market, I think, will take its own path or charter its own course as it develops. If you look at developed markets, we're looking at just plugging in technology through existing channels, coming up with incremental changes and optimization there. Whether you look at China, which has grown largely on specific solutions built upon existing rails, like cash management solutions. I think India, the problem is a lot more complex, right? Just breaking it down very simplistically across a distribution product, I think we've hit challenges on both fronts. The distribution gap is really wide. At the same time, the product design has a lot of scope for improvement. And while it's easy to say, you can throw technology, you can throw innovation, you can throw newer business models and tackle both at the same time, and that is happening by and large. But I think what we're seeing in India is that we need to figure out points of focus across. So distribution clearly is a major challenge that exists in Indian markets. The cost to serve customers is expensive, partly by product design, but partly also by channel design that legacy systems have been operating on. So we believe that there's a lot of scope in terms of business model innovation just by disrupting the channels that we're using, the way we're reaching out to customers. And as a natural segue from there, we can get into process design, which I think is an integral sort of middle step between distribution and product. So we're seeing automation, technology, disruption happening on all three verticals. I think distribution is it's an area where you can throw in technology, but there will be some component of tech and touch, because as an economy, as consumers, we're still a while away when you look at the broader population to moving completely tech, right? There needs to be some sort of touch point, like Subbu mentioned, some sort of guided interactions in the entire process. And process design is a sort of key step or key enabler to that distribution challenge as well. So we're seeing a lot of innovation happening on that front. Product, of course, it's subject to a lot of regulation, as and when regulators open up, take cognizance of the market needs, and that is happening in gradual ways. We'll see more of that happening as well.
Interesting. So you also mentioned that given that you guys have been doing funding companies in other parts of the world, where do you see India, and what is your sort of, from your view, where are we? What is the short-term changes that are likely to happen? What are long-term changes that are likely to happen when we look about through the whole fintech view as such, specifically wealth management?
Sure. So the two vantage points to this. One is from operators or operators' perspective, and the second is from the consumer's perspective. So operators' perspective, I clearly see in the short to medium term the distribution, the reach, newer business model innovations coming there, a lot of enabling technologies. We have a lot of tech rails, led by Aadhaar, led by digitization of identity cards across, and the way we process them internally, right? The entire KYC process and all those things. So in the short term, that's going to have a really large impact in terms of reach by the operators. And in the long term, the product innovation is really going to start kicking in. When you look at it from the consumer side, getting access to professional standardized services which are unbiased and transparent, I think that's going to be a short to medium change that is going to be positively perceived and is being positively perceived by consumers. Over the long term, I think there's going to be a lot of education and sophistication kicking in amongst investors, where we're moving away from, just looking in a, working in probably a binary world where you're talking about real estate, gold, bank account, and we're going to get more sophisticated in terms of our asset allocations as an economy itself.
Okay, all right, thank you. Sucharita, going back to your presentation, and as I was listening to you, the question that sort of popped up in my mind was that why would these folks actually trust you with the money, given that they have been so far doing things which are very close to them physically, and here is an app, and now they are supposed to make these investments, and if somebody thinks about mutual funds, some perception has changed over the period of time, wherein now you say mutual funds sahi hai, but until then the only thing we used to remember is mutual funds are subject to market. But how do you build trust in your customers with your platform?
So, I think that's a great question. So we do it through 2 or 3 different ways. One is, I think the partnerships are key. We choose our partners based on their standards of, obviously their scale, but also their standards of governance, their relationship with the customers, their standards of customer protection. Because if the customers have had a good experience with a certain MFI, and that MFI has actually lent money to that customer, there's no reason, and net, for a long time, we are still going to be in a space where the MFI is a net lender. As such, there is a good reason for the customer to trust a person from that channel, and that person comes from the community, by the way. It's not, it's not sort of a stranger. This is a person who has been interacting with the customer, let's say for the last 2, 3, 4, 5 years. So that relationship is there. However, has the trust of this customer been broken? Several times over, and customers continue to come back and invest in chit funds because of no choice, right? That's the only available alternative for them. So the other thing we obsess about is solution design, and we've designed our solutions to also create that trust. So for example, we combine systematic investments in the right mutual fund. We choose the mutual funds very carefully for this customer. We cannot afford to get it wrong, for this customer. But we also combine it with a liquidity line, because we know this customer has a very volatile life. So, the holding period of this customer is very low, right? It's a very short period. So let's say, for example, if I have a goal for 5 years, I might actually encounter a shock every 4, 5, 6 months. These are not, statistically, these are not big shocks. They may be 2,000, 3,000, 5,000 rupee shocks. They can actually be easily tided over. But that liquidity line that's secured against the mutual fund makes the customers able to touch and feel that money. To say that, you know what, I borrowed money against it. I actually got that money. It's real. It hasn't gone anywhere. Thirdly, if a customer says that, for whatever reason, I want to redeem, that experience has to be fantastic, right? Because that's where trust builds, that's where word of mouth builds, and that's of course the long race, right?
Sure.
As you perform better and better, execute better and better, it's going to get better. But I think it's those 2 or 3 things that come together to form that trust.
So you guys started with mutual funds, and so you said that this is one regulated product. It's easy to sort of figure out. How do you see, from where you started, what exactly is the role of a financial advisor? You have technology on one side, and which part of that is being solved by technology today, apart from the distribution piece, from an advisory part?
Yeah, so when we started, we defined our customer segment as people who earn between 5 and 50 lakhs. And I think now we are kind of extending it to people who earn between 5 and sort of 1 crore. And that's largely happening because of technology. Technology helps us solve 2 problems, one significantly and the other one, there's still some work to be done. The first problem it helps us solve is access. Because of it being an app, because of it being on the web, ease of KYC, ease of information, ease of payments. Some of them we've innovated, some of them the ecosystem is innovated, some of them mutual funds are here, as you said. I think access is a problem that technology has solved 95% of it. I think, as a result, we are seeing huge inflows of customers to platforms like ourselves. The second part is the advice bit, right? I think there has been some progress. I think there's some work that's been done on solving the advice bit. And my own sort of a conclusion is, based on the work that we have done, for routine problems, I think technology can solve. For example, if somebody wants to invest 5,000 rupees a month or 5 lakh rupees one time, I think that's a problem that technology can solve without a human being. Let's say somebody's built a 30 lakh portfolio, you want to sell and get a lakh rupees out. Which funds to sell based on exit load, tax, blah, 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 solved problem. Rebalancing, based on market events, how you move your portfolio on asset allocation depending upon, fund manager leaving, blah, blah, blah. How do you move customers' portfolio, solve problem. I think some of those problems that can be converted into sort of an algorithm for this segment of people that I said, because the segment I'm talking about has sort of simpler needs. They need a place to invest in a manner, they trust that platform. They probably need a place to buy insurance and pay premium once a year, similar health and life. They probably need someone to help them once a year in their tax filing. And if they're prudent, they'll probably take a loan twice or thrice in their lifetime. And they just need a platform to get that loan. So the needs are not that complex. The moment you cross 1 crore salary bracket, that's when all the complications coming in, LRS money going out, estate planning and real estate, and that is a harder problem to automate. But if the customer is going to remain within the realm of financial products, I think technology can solve 90-95%. We're not there yet. So at Fisdom and My Way Wealth, we've just done advice in these 3 layers: investment, rebalancing, and redemption. But I think a lot of these stuff that people are doing can be automated.
Sure. You did mention while you were talking in your presentation about the whole thing about jargons, and I think sometimes, and being an advisor, sometimes the thing that comes into my mind is that it's not necessarily that the client or the customer actually knows what questions to ask. It is what questions you ask the customer actually gets the need, right? Because he might be thinking that मेरे को tax saving करना है. His perspective, I want to save tax. This ATC is there or whatever is there, I want to put this aside to get best returns or whatever. But it is the questions that you ask essentially gets into the depth of what advice he needs to give. And here I need to say that whose responsibility is it to figure out, and this is for both of you, to figure out what he needs first. So there could be a customer who comes on your platform and says, I want to save into mutual funds. But if you asked him 2 questions, there could be a situation wherein maybe he needs a more urgently a health insurance policy or a life insurance policy, not necessarily an investment. So how do we bring in that piece of the responsibility of the financial advisor for both of you?
I can take this.
Yes.
So, this is a very important question. I do think that it is the responsibility of the advisor to do that prioritization. I'll give you a simple example. Somebody asked us, customers also ask us about Atal Pension Yojana, because there's lots of marketing, right? I mean, there are so many nudges in the media, etc., that customers will ask us about it. Say, why don't we have Atal Pension Yojana or any other pension scheme for that matter, on the platform? And and most customers who come to us, have not saved even for their near-term goals, more urgent goals, be it house repair or education of their children, or even a festival coming up, in the 1 to 5 year duration, with no matter how good the pension product might be as such, and it might be a good one, the fact that the money is going to be illiquid for the next 20-25 years automatically means that even if the customer comes asking for Atal Pension Yojana, it is, I think, and I think it's my interpretation also what the regulation says, is that it is the advisor's duty to ask the customer the right questions around, what goals do you have, what is most urgent, do you really not need the money are you sure you can spare the money for 20 years when actually the financial health report is saying that you might need it in 6 months. So, I do think that, whatever people will hear from their neighbors, from media, will come up, and that's why this is the job of an expert. That you hear something, and you might want to do it, but I do think this is our job and can be done as well.
Okay. So would you like to add something to this?
Yeah, so our approach has been actually on the contrary. We've, because of the fact that we are more digital and less physical, the more questions we ask, particularly in a low trust environment, people run away. And let's be honest, India is a low trust society. So every incremental question I ask on the digital platform only leads to increase in drop-offs. To that extent, frankly, as a company, first 2 years, all we tried to solve for was access. The whole advice piece actually started coming only about a year ago. Before that, we were just trying to solve, let the customer get started with something. And the idea has been, let's learn about the customer as the customer spends more time. And today with technology, we can go to the extent of personalizing the app interface. Somebody who opens the app every day to check his portfolio can actually, his dashboard can be different from somebody who opens it once a month. So there's such flexibilities today available because of technology. So we said, look, let's solve for access first. Let's get the customers started. And let's learn about him during the life journey, because because of the fact that we don't meet, unlike in Kaleidofin case where there's a trusted intermediary. It's largely digital sort of an interface. So trust building takes time.
Yeah, I'd just like to add that I think that there is a lot of merit in getting the customer started on a basic solution, which is sort of no harm done anyway, which is the access point, right? So even for our customers, we've designed sort of a base level solution that would work for almost any customer. So even if, for example, I don't know much, the customer doesn't have much time, customers are still time poor, right? They're busy. So you can at least get them started on the basic. And I think that there's a lot of merit to getting people started.
So essentially, we don't always have to wait for the most optimum solution, saying that let them get in.
As long as you don't get them started on a illiquid pension scheme.
Absolutely,
it's fine.
Makes sense, makes sense. So one other question, and one big development that is happening within the economics and financial sphere is this whole thing from people being rational to people being sort of behaviorally challenged in terms of how we make decisions, right? And more and more of research that is coming out that basically shows that the big impediment to creating wealth or making right financial decisions is essentially how we make our financial decisions. How do you say that sort of role playing out in terms of both for a digital player as well as where you have some touch and feel, because you will have market cycles and how does your role during those times sort of change, and how do you see that sort of?
Yeah, so I think great question. I think no easy answer. I think we are figuring it out. I think every other industry player is figuring out. I think we believe we can solve this problem of making our customers stay through their goals by having a sort of an active communication with the customers. But it's still, we're a 3-year-old company, right? I mean, last 4 months have shown us data that people are irrational, as you said. Look, the moment markets corrected, SIP cancellations went through the roof, redemptions went up. So I think these, I think we are still in that first wave of understanding the customer. We are trying to understand what works. But so far, our experiments suggest that if we have a active content-based re-engagement framework, I think we can hold back customers. And again, going back to my earlier point about technology, today allows us to personalized communication. Somebody who's invested 20 lakhs can get a completely different communication for the same event. Let's say RBI did something, the government did demonetization or something. The same event can result in 10 different communication being sent to 10 different people. And the communication could be different in both form as well as format. Somebody could get an SMS, somebody could get a detailed email, somebody could get a notification, and the content can also be different. But the short answer to your question is, we're figuring it out.
Makes sense. On the question, and you deal, I'm assuming, a lot more with that, given the population that Fisdom is targeting, is that how do you handle the challenge of diversity, which is like everyone is saying that India is like 20 countries in one country. So how do you challenge and build a product which is working at a national level?
So we actually use 3 or 4 data sources, and our customers are traditionally sort of data poor, right? Relative to like the 5 lakh to 1 crore, you have a lot of social media content. You have, you're an app on the phone, which itself gives you access to a lot more information. But still, I think we made a lot of progress as far as data is concerned. So we have 2-3 different sources of data. We have credit bureau data. And about 50% of our customers do have credit bureaus, and they can be fairly long credit bureau records, as much as 5 years long. We have a lot of data from our partners, which could be as much as 10 years of data of, let's say, loan transactions, as well as demographics, type of house, and so on. We have location-specific data. So we actually mine a lot of geography type data. So for example, by the width of the street on which you're living, what your wealth might be, right? What kind of house you might be staying in. Even from that, of course, there are other more traditional sources like census data, which give you lots of information. So for example, in some geographies, we ask the question that how many months do you use LPG, which is gas, a gas cylinder, in a year. So in Bihar, in Rajasthan, we ask that question. In Tamil Nadu, we do not ask the question because it's universal. So there are a lot of data sources that are available in the public domain. And it's getting richer and richer. If we had access to mobile recharge data, it would be beautiful, but there is no good way to get access to that today, but that would add a lot to the picture. But we basically personalize our recommendations, not just the recommendations, we personalize the assessment and the questions themselves and the recommendation. In accordance with all of these geographical factors. Yeah.
Varun, I'll come back to you and ask you 2 questions which are linked. One is very close to the heart of CFA Institute, CFA Society, which is around ethics. Something that we have to read up and something that we sort of pretty much keep thinking about as we are giving advice. So one is the ethical piece, one is the whole regulatory and compliance piece. How do we sort of within a tech-based system sort of keep a check on both the ethical, and this is not from an ethics from an investor and a funded company perspective, but from a customer and an advisor perspective. So your thoughts around that?
Yeah, I think that's one of the sort of paramount pieces that even we, look into and discuss extensively with our founders across when we engage. And it's with technology there is there's a tendency of packaging stuff. This is it. Why don't you buy it, right? But there's a lot of fine print which we've all been used to so far. You check the box, you've read terms and conditions, it's all done. I think that needs to change, and that is changing, right? So you got to be very clear, transparent in terms of your communication to the customers, and a key part of that entire paradigm also is, what Subbu alluded to earlier, de-jargonize. Make it simple. Make it simple for customers to understand. It's not what you've communicated, it's what the customers heard, registered, and understood. And that is far more important. then you check in the box, hey, I've written these 10 bullet points, could be hidden somewhere in like a 10-page user agreement that they've signed. So I think that transparency, clarity of communication is a key part of the ethics, right? And that's even more important when you are an intermediary, right? When you are working as a distributor for other products, because you have incentives as well. You have, you might be working on a commission structure. Just having that clear communication on what's in it for you as well at some level is important. We've seen a lot of wealth advisors, you have a lot of churn in your portfolio happening every couple of times because that's how incentive structures have worked traditionally. So being transparent and keeping consumer protection at the forefront in terms of what you do, I think it's becoming supremely important. A lot of ways in which you access data as well from the customers has now come into the limelight over the last couple of years. We have GDPR, we have all these platforms now clamping down, saying, why do you need to read SMS data of customers? Have they granted you explicit access? What are you going to do with it? Who's going to use it? Right? I think all these questions have now thankfully come in the limelight, which a lot of the more mature players have been self-regulating, some have not, and we've seen the consequences of that. So I think it's a combination of transparency, clarity, communication, being self-regulated, because regulations are not always the quickest to catch up. Regulators also have an external exogenous vantage point. So as an operator, I think that ethics, and that's really the DNA which gets reflected in across business practices that you do, right? The way you draft your agreements with your customers, what is communicated, all these things are sort of reflected off the ethics. So it's not a window or a checklist. It's not like one single brush stroke. It's complex, but it gets reflected in multiple layers and touch points there. On the regulatory front, I think, by and large, it has been black and white, but off late, I guess all of you would agree, there's been a lot of back and forth, there's been a lot of ambiguity also when it comes to regulations, what's kosher, what's not kosher. And that, again, being self-regulated, knowing what the right thing is. So even if the regulation demands something or does not demand something, more importantly, just being more forthcoming and proactive in providing for the basic norms, I think that's becoming more important as well. And that's why technology as a layer has improved the ability of operators to do things like KYC, fair disclosures.
All right, thank you so much. On this ethics bit, and I want to sort of delve a little bit deeper with you guys, is that how do you monitor, saying that, so one part of this whole thing is like Varun mentioned, being transparent, telling the customer what kind of data you're collecting from him, why are you collecting the data, and so on and so forth, what is the end use of the data, and so on and so forth. From an algorithm perspective, there are certain algorithms which are running at the back end, and how do you ensure that they are primed to give right advice, and if they end up making mistakes, how do we then go around after that? So I'm sure you must have thought of scenarios, so what happens? So go ahead.
So I think we are still a small company. We are 100 people strong. I think in a company like ours, I think the buck stops with me and my co-founder. We have to take full ownership of whatever is being recommended on our platform. I think it starts with us and ends with us. We have a full-fledged research team. We have some ideas that at some point we'll execute. For example, putting out our complete research framework for the public domain for anyone to kind of evaluate whether this makes sense or not, people to comment or not. At some point, we'll have a research governance committee, and Varun would know these are the ideas that we've discussed in the board but never implemented. But there are thoughts in our mind how we want to do it, but for the scale and stage where we are in, I would say, me and my co-founder personally drive and try to make sure that, we are not recommending number 40th in the list of AMCs just because our commission is high. So this principal agency problem is for real. I'm sure all of you would understand, right? Let's not wish away that. So we have to work hard towards ensuring that we are not kind of getting lost in that, look, let's maximize for our sort of this thing. And I think in some sense, recent SEBI's work around removing upfront, making all trail, particularly on the mutual funds, it's a good step. Now you're aligned. If the customer loses money and goes away, you lose the entire sort of commission. I think the regulator is doing a bunch of work. At the end of the day, we are trying to do our own bit, where what gets recommended finally gets approved by one of us.
since we come into this principal agency thing, the upfront and the trail model, etc., and we can keep debating of what is the best model. But essentially, whatever you are being paid, either you are being paid as fees or you are being paid as commission from the product manufacturer, the intermediary, the advisor, the agent has to earn his sort of money, right? And that there's this whole debate going on between whether you should take it as a fees, whether you should take it as a commission. How do you guys see this evolving? And I know there is no straight answer in here, but a quick comment from both of you. And then Varun, I would like you to comment on this, given that we have this whole thing happening in a regulatory space. As an investor, do you get sleepless nights because of this?
I do think that, the regulator is also thinking about issues of access. So if you, for example, say that, okay, you should only advise the customer, and if you provide advice to the customer, you cannot earn any distribution commissions. I do think that makes an entire, it could potentially make the entire, agent network completely unviable, because, our customers actually still, they do pay us for advice because, it's so hard to get. But I seriously doubt actually that the next layer of customers will actually even pay for advice. I'm not sure at all. Our customers actually used to paying foreman's commissions of 5%. So for them, you go from 5% to 0.6%, they already paid 5%. So it's very different for our customer segment, and it might even be a model. But I do think that, access matters. And while the structure of the commissions, like you said, is important to be aligned. And I think rather, why don't we focus on making sure that each distributor actually is assessing that the recommendation is suitable. After all, why don't we go to the heart of the problem rather than, making a lot of these rules, because that's what you're trying to solve for, right? And today, I don't think it's a level playing field. When I look at all the digital players, I see some that are investing a lot in recommendation platforms, right? And it's not cheap.
Okay.
The talent is not cheap. The tech is not cheap. None of this is cheap. The research teams are not cheap. It's a significant investment of capital. There are some others who are also very large, who are not investing in it at all, and who are making this sort of super simple. I will not ask you even a single question. You can, and they're also selling mutual funds. Now, this is not a level playing field. The thing is that both of these distributors technically are supposed to assess the fit of the fund, but one of them is doing it and the other one is not. So I do think that the creation of that level playing field may even be a more important issue to solve for. It's a harder issue. It needs regulatory capacity and bandwidth, but I think it should be solved.
So any quick comments from you?
So I think, you mentioned 20 Indias. I think the customer profile is a bit of a spectrum, right? I mean, there are people who will pay for advice, and there is a large segment of people who will never pay for advice. In India, nobody pays for advice, let's be honest. It's very hard to make people, I'm sure there are wealth managers here, like investment banks, for example, it's very hard to make money out of advice in India. But having said that, will it change? It will. When Swiggy started food on delivery, people wouldn't pay for delivery charges. Now we all pay 50, 60 rupees for delivery charges. So I come from a world where I've seen consumer behaviors change. So it might change over 5 years, but if I have to comment based on what is today, I think there is a spectrum of, potential customers in India. There are 1.5 crore people who invested in mutual funds. Probably 20 lakh of them are in direct plans and remaining are in regular plans. And hopefully the market will go from 1.5 crore to 5 crore, right? I think the way I see it is the savvier customers will move towards direct plans. They might consider paying. I'm not saying they will. They might think about paying. But my guess is the incremental customer base which will come, I think is quite indifferent between that 1% extra commission, because, the reality is you will end up earning 1% extra if at all you earn returns first, right? So I think there is some value to some advice. I think all I'm saying is different segments will move in sort of different directions. The HNI money probably will move towards the advisory model. There you will have a slugfest between the advisor and the customer, and whether it should be 50 basis points, 60, 40, all kinds of stuff. But I think that segment will definitely move towards advisory model. Rest of the market, if you ask me, is quite indifferent. As long as there is money being made, there is an alpha between FD and what they make, I think they're fine.
So essentially suitability and the final outcome is what should be the core of the discussion, and not necessarily whether you're being paid by the manufacturer or the client directly or and so on. Okay, all right, interesting. Varun, from your perspective, so in India we have multiple regulators, and within the finance space you have these financial products. So you have basically insurance is IRDA, which is a different regulatory environment. You have SEBI, which is dealing with funds, with all this direct and regular and all of that. And then you have the fixed deposit business, which is under RBI. So how do you think about all these aspects when you are looking at your companies and when they sort of come back to you?
Yeah, I think, it's a very pertinent question, and it's something that we spend a lot of time, or we have spent a lot of time thinking about. And it's becoming increasingly more relevant because I think, by and large, as a market also, we are coming to some sort of an agreement that we need to be multi-product, multi-product companies, stemming from the fact that customers' requirements are broad, right? So that building that single point, single product, vertical play which scales, which sort of, scales right through India, I think while the premise itself is not being challenged, the time taken to get there, and whether, startups as, tap for resources have the ability to get there and last that time is being questioned. So that multi-product approach works both ways, right? I mean, you're providing customers with a broader suite of services, you're taking care of the needs. At the same time, from your monetization, from your economics perspective, it makes a lot more sense. What that, to you as, the question as an operator is, again, you got to work with multiple regulators. For certain things, we see the plumbing lines being harmonized across, right? But still, that discrepancy does exist, that to sell an insurance product, I mean, a digital signature may suffice. But if I'm opening a bank account working on, under the RBI, I still might need a wet signature. And I think these things need to be aligned at some point, right? Different regulators have different priorities, work in different paces. So I think that's a more gradual outcome that we should see happening in a couple of years. I think right now laying down base layers and plumbing lines of things like, having digital identity, e-sign, document storage, etc., being a centralized resource which these guys can tap into, that is great. That's a great outcome that's happened over the last couple of years. That should first of all stabilize, which still hasn't happened. We're seeing a lot of back and forth on what's right, who the right authority is, all those questions are popping up. I think once that stabilizes, we'll see a lot more reception from regulators to harmonize that.
Okay, interesting. I'll move on to the whole aspect of quality and saying that from a technology perspective, you can really define quality. And a question to both of you, what are the metrics that you are internally sort of checking that whether our quality is top notch or no? So what are those metrics that you guys are looking at, saying that, hey, is our quality up there delivering the goods? To both of you.
I think, from an advice perspective, it is, are we generating superior returns to the index? I mean, it's as simple as that. Whether our recommended portfolio over a period of time, is it doing better? Is it doing worse? I think there is no other metric that we can measure from an advice perspective. But as I said, a large part of our work is around access as well, just making it easier for people to access. I think there we measure things like, download to KYC, amount of time it took to KYC errors, a number of transaction failures, percentage of transaction failures, payment failures. These are all the metrics that are sort of more towards the access part of our business. In the advice part of our business, it is, are we generating alpha compared to the index or not? And in terms of the recommended portfolio, are we in the top 25 percentile of the relevant base or not? But we do end up spending a lot of time on the kind of access-related metrics that we, more for making ourselves better and better.
Makes sense. So basically, right now the focus largely is a lot of the operational piece and getting bit access. On the advice side, it is largely focused on saying that, hey, are we beating the benchmark sort of?
Yeah, exactly. Yeah.
Okay. For Sucharita, for you guys, what are the metrics that you are currently tracking and across advice, access?
Yeah. So on our recommendation itself, we actually have to look at various measures of risk-adjusted returns, because it's very important what kind of risk the customer took to achieve the return. So because it's what could have happened. So we actually look at probability distributions of returns even during selection over the entire fund's history, because precisely because you may in financial markets we know that you may have got there, but you may have taken an exceptionally high risk and gotten there. So we look at risk-adjusted returns. We look at volatility of returns as an independent variable, because we know that again is a metric that customers are going to be very, very sensitive to. So especially our customers. So these are particular to our customers. We look at on the operational side, for example, how long did it take us to do KYC? How long did it take us to set up a bank mandate? How long, how many of those were rejected? On the claims side, how long did it take us to actually process a claim? Because that's where the rubber really meets the road.
Yeah.
If you, on redemption, on claims processing, if you do your job really well, the customer experience will be good. Because otherwise that, mistrust develops that, okay,
Absolutely.
what's happening and what's not happening. So the other thing because we have actually agents also in the mix, in the middle, who are operating the app. So we actually check agent quality of consent, and we check agent data quality. So those are the two metrics we check all the time. So because the thing is that this customer is actually very trusting. So I might give Varun my phone and everything, and he might have put the OTP for me. So because I trust Varun for no rhyme or reason, let's say.
Yes,
and so whatever security you put in place has been compromised already. So the thing is, we have to check consent once more, because it might happen and we know it might happen. So rather than turning a blind eye and saying that, hey, you know what, hota hai to hone do, we say that, okay, we'll check once more, and plus the quality of the data, however, it's like garbage in, garbage out. So if the data is good, the recommendation will be good. If data is bad, and vice versa. So we check both of those, and those are also quite, agent activity is very important for us.
And something like this, which we very often see, is this whole risk profiling thing, and especially when it is done offline, the guy just sort of takes it, and because he wants to do a certain product, because that's where the commission and income is more, that's how your risk profile sort of comes up. So you checking against something like that.
We check that independently.
So I have a bunch of questions from the audience. I have a couple of my own. I'll take one of mine and then I'll go to theirs. And this is something that came from the chat that we were having before we started our session. And I would like just quick comments from all of you, is that there is already so much infrastructure that is available in form of agents, in forms of financial advisors who are either working offline, online, and so on and so forth. Where do you see collaboration opportunities with the existing infrastructure? It could be in many ways, just somebody using your technology, somebody using yourself. Where do you see, if you were to just think about these collaboration opportunities as such?
A shot. I think Varun Dua in the earlier session alluded to it. Companies like ourselves end up being significantly consumer product companies, right? We understand consumer, user experience, user interface. That's where the starting point for most of us is. And we, over a period of time, learn the sort of domain. And learning domain from first principles, let's be honest, hits the roof at some point in time. For example, before I started Fisdom, I did not have a single mutual fund investment. I was an all equities person. I used to trade, invest in equities. So I had to learn from first principles. Now 3 years into the company, can I do that? No, right? I think now we are trying to bring in people with domain expertise who can do some of this stuff better. Like for example, the entire rebalancing algorithm in our app has been written by somebody who spent a few years just doing this as his life. I think as technology companies like ourselves scale, we just don't have an option but to work with people who have a domain expertise. And domain expertise in investments world tends to be a lot more complicated than, let's say, insurance or loans is complicated because there could be, the credit underwriting can be like you could do a matriculation or you could do a PhD, it could be anywhere. But investments, as you add more financial products, as you add more data points, can get complicated. So I think companies like ourselves will look to scale up our research capability significantly. And the second part is, one is research, the other is how do you translate that research findings into consumer, in a format that the customer can read. So in a way, I keep saying this, we need two kinds of product managers. One is a financial product manager who understands the financial product and makes it easier to understand. Then there's a consumer product manager who starts from there and puts it on a user interface that a customer can consume on a mobile app or mobile screen or a desktop screen. The second set of skill set is fairly available, is an abundance. The first skill set is not there. It's not like, taking a reasonably complex product like a PMS, and let's say if I give a task, look, make it easy so that a guy who earns 30 lakhs a year, who's an engineer in a company, who can understand this, break it into parts so that he can understand. That skill set is not available. Hard, at least I found it hard.
Yeah, so specifically on collaboration, I think, just going back to Varun's point on creating standards for communication, for transparency, I think it's much better if we come together and actually debate, discuss what should these be, and what's fair to the customer, because everybody will have a different point of view, and then I think it's so much better than having a lot of prescriptive regulations in place. So I do think that that's an urgent area for actually collaboration, where I think everybody stands to benefit, will create a more solid industry, and it's better for the customer as well. And people, institutions who are not adhering to these standards will automatically over a period of time get eliminated, because they're just not kosher, no matter how well you're doing. So I do think it has sort of many advantages. So I think that's probably my top pick for collaboration.
Okay. Yeah, I think, just taking a step back, looking at a macro perspective, I think fintech is probably amongst the various tech industries that have evolved over the last decade or so. Fintech is probably the only one or one of the few which, whether you like it or not, you cannot operate out of the existing system, right? You are a financial services player. You're using a lot of tech, you're making leaps and bounds of progress in the way you're designing products, etc., but you're still a financial services player. Right? You have regulatory touch points, you have some sort of touch points with the existing, distribution system, maybe incumbents, maybe manufacturers, whatever suits your particular business model, but that's there, right? And with that entire piece, I think that collaboration is sort of necessary and organic, right? You're not disrupting the entire industry in one shot. You're working with different parts, you're disrupting specific parts of the industry or the value chain. So it's really important to understand what those gaps are, and sort of, surgically or specifically target them, as opposed to saying that, what, I'm going to operate out of the system entirely. Okay. Right? So whether you talk about intermediaries, why a lot of mis-selling has happened over the years, which has built consumer distrust, you ask yourself, there's no malintent involved there. It happened for reasons. It happened organically because of skewed incentive structures, because of skewed communication paradigms that existed in the financial services industry. I think collaboration really there can really change the way the entire industry operates and is perceived.
All right. I'll go into the audience questions. The first question, Subbu, if you would like to sort of take a thing on this, is that how important is this whole thing of customer education and awareness around this whole financial education bit that we are talking about, and how do you specifically give them the importance of risk profile?
I think awareness is at two levels. Excuse me, sorry. I think when we started 3 years ago, there was no mutual fund sahi hai. Let's separate the awareness between the product awareness and specific, what is relevant to that customer, right? The product awareness has to be taken by the industry as a whole. I think, unless we raise billions of dollars of capital like some of the other startups have done, we will have just no capability to educate and create a market. I think the market creation, particularly for a regulated industry like ourselves, I think it's best done by an industry body. I think AMFI has done a terrific job. I hear IRDA is coming up with something like insurance zaruri hai or something like that. So there is a new campaign that's going live apparently, which is nice. I mean, it will improve business for all of us.
Yes, absolutely.
Right.
Yes.
So I think awareness about a product and a product category, I think it's too expensive for people like us to do. I think it has to be done by the regulator. Thank God somebody has started. Hopefully others will kind of follow. Because of the fact that people are seeing these ads and people are coming and trying. Like for example, a large number of transactions that are happening, are 100 rupee, 500 rupee, 1000 rupee transactions, right? And these are people who are taking this, orientation that look, let me try and see what happens. So there is still in the trial mode, right? So for those customers, we don't want to sell the rocket ship.
Yeah.
Look, transact. Look, I'm happy to be a sort of a transaction platform. But at some point in time, these users will graduate, or we get customers who will do 10 lakh, 5 lakh, 20 lakh, 30 lakh on our platform. I think the way I see is the following, right? I have sort of a benchmark for us. If a customer is doing more than a 10,000 rupee monthly investment, SIP, or he's doing a one-time investment of more than 10 lakhs, I think that's when the threshold comes where the customer needs to be aware of what he's doing. Less than that, the materiality concept I would apply and say, what, it's okay, let him try. We'll figure out what happens. But if he crosses these two thresholds, I think the customer has to go through some sort of profiling, some sort of awareness.
Got it. All right, thank you. Sucharita, this question for you. You guys do multiple products on your platform. So how do you check on the agent incentive? Because there might be certain products which are paying him a higher income versus certain other products. So how do you sort of keep track of it so that there is no mis-selling, to say so, that is happening on the platform?
Yeah, so actually the way we sell financial products is together as one solution or one micro plan. So we don't actually sell credit separately and funds separately, the credit lines separately. These are packaged into solutions that you take together. That's number one. So there is no question of between product between product incentives. The second thing we do is that actually the agent's incentives don't change at all. So we, depending on the solution, it does not matter. There is no difference at all. We, as to what the agent gets paid, and we've been very careful about that because. And the third thing is actually the agent cannot change the recommendation on the app. So there is no discretion whatsoever. And again, at this point, we are being doubly careful because, again, we are young. We don't want to make, mistakes at this point of time. Over a period of time, as the confidence in the agent network, etc., increases, will we release some of these, perhaps? But I think a very powerful thing to control is to keep the recommendation, the machine's recommendation, because in any case, in our experience, you get extremely inconsistent recommendations from real people.
Okay.
And training doesn't seem to solve for that.
Yeah. Got it. A very quick take from you. Do we see a similar, like the Alibaba had a money market fund, which was do you see something like this happening in India?
I hope so.
Okay. All right.
I'm not getting the two of you to start something. But no, again, but it's important to understand the context in which that product developed, right? This was what, I think 7, 8 years ago when Yueba was launched. You had a large percentage of penetration of internet transacting population, right? Alibaba, Tencent, they laid down the entire distribution rails to plug in anything that you could possibly think of at that point in time. And Yueba was launched as a cash management tool. The entire messaging was, you earn this much on a fixed deposit or in a savings account, I'll give you 2% more, and you can withdraw your money at any point in time. So that was contextual to that particular market need. There were a lot of SMEs, a lot of businesses that hopped onto the platform as well as just a cash management tool. And I don't know how many of you know that, but it's within 5 years since launching, it was the largest money market fund in the world, ahead of JP Morgan, Goldman Sachs. And that's not a small feat by any stretch of imagination. But again, it was contextual to China. I think the market needs here are slightly different, right? And as and when the regulator opens up on the product piece, maybe we'll start seeing more, more innovations coming there, more looser or more customized, bite-sized products that people can, understand easily, play particular themes, ETFs, I don't know. So, but we'll see probably it evolve in a different way than China.
Okay, thank you so much. I've completely run out of time, but I do want to put in my last question, which is, when you're looking at people and hiring people, what are the skill sets? Obviously, apart from CFA charter holders that you should hire, what are the specific skill sets that you are looking at today? Very quick answers. Things that we are not thinking of that we should add apart from whatever else that we are doing, whether it's the CFA, whether it is what else we should be doing.
Yeah, so talk about my own firm. We are hiring engineers, we are hiring product managers, and we are hiring operations people. I think specifically to this audience, I go back to what I said a little earlier. I think there is a dearth of talent that can translate from financial engineering knowledge from spreadsheets to Word documents to something that can be used on a mobile screen or a web screen. In a very broad terms, it's called product management, but there are nuances here, right? As I gave you an example earlier. I think that's a skill that's missing, because for a typical product manager who comes out of a business school or an engineering school, etc., it's easy to visualize how a customer uses. If it is a product or service, he or she familiar. For example, like I give you example of Swiggy food. We all eat food every day, right? So easy for us for the product manager to visualize how it should look, whether it is taxi. But the moment it goes into these domains of healthcare and financial services, which are a lot less frequent, it is very hard for a product manager to visualize, okay, this is what the customer wants to see and this is what the customer should see. I mean, these two are two different questions, but I think that's where we really have a dearth of talent, which is where financial services financial product manager meets a consumer product manager. Looking forward to such people.
Suchita, you want to add anything to this?
I think I would totally agree with what Sue has to say. I think the only additional thing we'd be looking for is actually people with experience in the informal customer segment.
Okay.
Very different dynamics.
Okay.
To people like you and me. So, and that's a skill set that needs to be developed.
All right, thank you so much. You folks have been great panelists. We had a very sort of broad discussion around wealth management and fintech. Thank you so much for your patience. Thank you so much for your questions. You've been a great audience. Thank you so much.